We'll start off by focusing on the financial policies, and then we'll move to monetary policy, and finally to fiscal policy. We will look at institutions within the developing country framework to see how they differ than similar institutions in a developed country framework. We'll also emphasize one important theory, I say a very important theory, the Mundell-Fleming model, and this focuses on the role of exchange rates in the macroeconomic decision-making perspective. Let me quickly summarize the main idea in the Mundell-Fleming model, also known in theoretical circles as the ISLM-BP model. It focuses on expansionary and contractionary monetary and fiscal policy and the impact these two policies have on interest rates and real output. The model focuses on two regimes, a fixed exchange rate regime and a flexible exchange rate regime. One should keep in mind that the world of flexible exchange rates is post-1973 for the most part, and mainly industrialized countries that had flexible exchange rates. When we discuss the financial crisis of the 1990s, we focus on the fact that Thailand had tied its currency to the US dollar, and while Thailand had a fixed exchange rate with respect to the US, it had a flexible exchange rate with respect to all of the countries against which the US dollar was changing. So as the dollar strengthened, the Thai baht also strengthened, and according to the theory we met earlier, that says that the net exports is a positive function of the price of foreign currency. In this case, the US dollar was becoming more expensive, but the foreign currency for Thailand would be not the US currency, but other currencies. So therefore, when the dollar was strengthening, the baht was strengthening, but the way we model that is to say that the price of foreign currencies, non-US dollar, non-Thai baht, went down, and that would hurt the trade balance. That would have a positive correlation with the trade balance, but the lower price of E would cause a lowering of X sub N, which is net exports. This leads to a trade deficit, and according to the simplest theory of balance of payments, the balance of payments balances as the sum of the current account and the financial and capital account. So that if these sum to a zero in a flexible world or a well-oiled machine, these would be the opposites of each other, summing to zero. One then have a positive sign, the other has a negative sign. So when the current account balance is negative, the capital account balance should be positive. We need a little more theory in order to flesh that out. So we need to talk about theories such as purchasing power parity and interest rate parity. Interest rate parity boils down to this. If the interest rate in your country is more attractive than the interest rate internationally, capital will flow into your country because it's seeking a higher yield. Now, the interest rate is not the only variable in this equation, but in the simplest version of the model, exchange rates are fixed, and the fixed exchange rate effectively removes the other variables from the equation, so you're basically comparing your domestic interest rate with a foreign interest rate. And ceteris paribus, as you raise your interest rate relative to the rest of the world, money will flow into your economy. This theory was developed not for poor countries, not for countries with weak financial and monetary systems, but for countries with a well-oiled financial system. So the question arises, for countries where the financial system does not respond appropriately, will raising your interest rates result in an improvement in the financial and capital account? At some point earlier in the course, we said that in many cases this is not so. Money does not flow directly into these poor countries when they raise their interest rates, because the reason they raise the interest rates has to come into the equation. If you're raising your interest rates because there's high inflation in your country, that would be a deterrent to foreign investment. Or if raising your interest rate makes it look like you're trying to somehow force the system to be responsive, the question is, will the system actually respond? If you build it, will they come? As I said, the theory is more for industrialized countries where finance flows easily and the system works well. But for developing countries, it is not likely to be the case. So be aware of interest rate parity, purchasing power parity, and the variables in these equations. I could quickly summarize the current account as exchange rate dependent. So X sub n is a function of E positive. We said earlier that as the price of foreign currency rises, the trade balance ceteris paribus will improve, of course allowing for the J curve effect, which says that you devalue your currency and people start avoiding you first. Eventually, this devaluation might result in an improvement in the trade balance, which is the IMF's traditional recommendation that you liberalize your exchange rate policy to allow market forces to determine the exchange rate. The problem is that your own citizens can bet against you if they see the price of the domestic currency falling. As the price of foreign currency rises, they might all decide that they want to speculate, to buy low, in other words, get the foreign exchange when it's cheap and sell it when it's high. So the devaluation of the currency can become a cat and mouse game where, because the price of foreign currency is going to rise, nobody does anything but tries to accumulate foreign currency so they can cash in on the buy low, sell high philosophy. There also is the idea that confidence can be lost because if individuals are not sure where this devaluation is going to end, they might keep thinking, well, it's going to keep going, and if it keeps going, the more we sit on the sidelines and watch the game, the better off we are. This results in a lack of productivity in the economy because individuals are engaging in what theory calls rent-seeking behavior. The buy low, sell high idea is a rent-seeking behavior. So we have the non-flexibility of the exchange rate equation, a la J curve, that the devaluation can actually hurt you rather than help you in the short run. Then we have on the financial and capital account side, the fact that you raise your interest rates and no one invests in your country because the country is not well integrated into the world financial system. Then neither of the things that work for rich countries in a well-oiled economy will work for poor countries where the mechanism does not exist. These are the hindrances then. The Mundell-Fleming model gives us 4 important results. 2 under fixed exchange rates and 2 under flexible exchange rates. So our 2 policy variables are fiscal policy and monetary policy. We should define these terms at some point. And in traditional macroeconomics textbooks, a very simple definition, or representation I should say, of fiscal policy is an increase in government spending, ceteris paribus, which means that we are running a fiscal deficit or narrowing a fiscal surplus to 0. So if you think of the budget as revenue minus expenditure, or expenditure minus revenue if you're talking about a deficit, then we're saying that an increase in government expenditure, ceteris paribus, will worsen the fiscal deficit. If an increase in government spending is matched by a corresponding increase in tax revenues, then the budget doesn't worsen, and the question then becomes what actually happens if there's increased government spending that's matched by increased tax revenues. Effectively, we're saying that the government sector is expanding and the taxes are coming from the private side of the economy, so we're shifting towards a larger government in our economy if we are increasing G, government spending, and T, tax revenues simultaneously. Generally, when we talk about fiscal policy, we're talking about increasing government spending without necessarily narrowing the fiscal deficit, so that, for example, increased G, holding T constant, would be an expansion of the fiscal side, but there is no matching on the tax revenues side. Expansionary fiscal policy then would be represented by an increase in government expenditure, holding tax revenues constant. And the question then becomes, if government wants to spend more, where does this increase in demand for resources come from? And where does it lead? So if the government is trying to increase demand, government is engaging in expanding the size of its sector, then if there is no excess of resources, then the government effectively is crowding out the private sector by taking resources away from the private sector. If two people want the same thing, the solution is to bid the price up. And in this case, if they're trying to borrow the same resources or gain access to the same resources, then the price of these resources must increase. To the higher bidder go the spoils. Generally, when government wants the resources, government will be willing to pay a higher price. Let's assume that. And that higher price will mean that the government is going to outbid the private sector for these resources. The private sector is going to downsize as the government sector expands, and we're not sure that we've done much of anything under those terms. All we've done is made the government a larger segment of the economy at a very simple level. Contractionary fiscal policy then would reverse that and move towards more private sector activity and less government sector activity. In a world where the resources are scarce and there's nothing available to easily be mopped up. Historically, as we think about fiscal policy, we think of John Maynard Keynes basically saying that in times of recession, the government should jumpstart the economy by expanding fiscal policy, which in very simple terms might be something like hiring workers who are unemployed, giving them something to do, and this money in their pockets then generates its own demand for goods and services, and I call that government jump-starting the economy. And then once the economy is moving along, the government can back off and let the private sector do its thing. So there's a lack of private sector confidence, the government sector expands, and hopefully it gets the engine going again. John Maynard Keynes also said that in times of recession, government should engage in expansionary spending, but when times are good, the government should fix the problem it created, so to speak. In other words, the government should try to balance its budget or to repay the deficit. So there's cyclical patterns of government expenditure and government fiscal budgets. So fiscal policy, expansionary government spending, ceteris paribus. Monetary policy, expanding the money supply. Traditionally, macroeconomics textbooks assumed that the central bank was autonomous and the monetary policy was independent of fiscal policy. Under those terms, then expansionary monetary policy would be the central bank deciding it wants to increase the money supply. The reason it increases the money supply is because it wants to push the interest rates down. It puts more money in the system. By putting more money in the system, it makes it possible for borrowers who can't get access to this money to now gain access. Also, by lowering the interest rate, it makes it possible for projects that were not feasible to become feasible because the cost of borrowing is lower, so that makes an opportunity for profit for the investor, so to speak. And not only on the production side, but also on the consumption side, lowering the cost of borrowing can allow consumers to expand their own expenditure patterns. There's something you wanted to buy and now it's cheaper to borrow the money, therefore it's cheaper to get the product that you wanted. So on the goods and services side, lowering the interest rate should stimulate demand by consumers and firms. On the financial side, it will discourage saving, and that has to be a concern too. If savings rates are somehow correlated with interest rates, or saving levels are correlated with interest rates positively, then lowering the interest rate will discourage people from saving in financial instruments, and they'll move their resources to other alternatives. Makes sense that you're not stuck with one investment opportunity, but you move to something else. I said investment, but savings are not really investment. One opportunity to hold money. So there's a whole lot of theory that needs to be put in place before we can get to the meat of this chapter. However, the authors start by looking at the financial system in the developing country and ask, does it work well? And if it doesn't work well, what is needed to improve the performance of the financial system? So if you view the financial system as the fuel in your car and the oil that lubricates the different parts, then you know that you need the finance in order to produce real output. The real output would be the productivity of your car, which will not happen without the financial system working. Of course, it's possible in a world of barter to think that you don't need money, you just need resources, and if you have the resources, then you can produce what you need. However, because we're talking about an economy where there's deficit units and surplus units, the financial system mediates between the deficit units and the surplus units and moves resources from those who have it to lend to those who want it to borrow, and it just improves the performance of the economy. Hopefully that is a simple enough analogy to make the point that there's a role for the financial system. When we come back to monetary policy, if we define monetary policy solely as the domain of the central bank, in fact, if we use the textbook's definition of monetary policy, it reads like this: activities of a central bank designed to influence financial variables such as the money supply and the interest rates. Two variables, the money supply and the interest rates. So we talked about expanding the money supply in order to lower the interest rate, so we can go with one policy variable then, the money supply. And if the money supply is manipulated, the interest rate would also be manipulated. That's the beginning of the monetary policy idea. So we defined fiscal policy as government increasing its expenditure or reducing its taxes. Expansionary fiscal policy then would comprise of either expansion of the government spending or contraction of government tax revenues so that the fiscal deficit is increased or widened, and monetary policy would be the increase or reduction in the money supply so that the interest rates will either go down or go up, and that would then have ramifications for the private sector of the economy. The chapter starts by looking at the role of the financial system in economic development, and I will point you to a comment or a result by Hugh Patrick. And Patrick offered a stages of development argument that financial development causes growth at the start of modern development, but once the financial system is established, it mainly follows the real sector. So going back to that simple idea of the real sector, which is production of goods, services, and the financial sector, which is money moving through the system to facilitate transactions, etc., then the more you can increase the degree of financialization of the economy, to use Patrick's term, create more banks, create more uses of money, allow more financial transactions to take place, move from a world of bartering, where you're trading one product for the other, to a world where money becomes a store of value or means of exchange, or all the traditional definitions of money that you may have met in the principles of macroeconomics class or in a financial markets class: store of wealth, means of exchange, and unit of accounting. These are the three traditional definitions of money. So if you start from a world of no money to increasing the availability of money, then you can see how as a store of value, it can allow an individual to perform one transaction today, receive the money, and then use the money tomorrow, so there's no immediate need to fulfill the exchange process, so to speak. This means that individuals can then decide to save, and while they're saving, they can make their monies available to others who don't have money and need it. As long as you can get it back by the time you need it, then you've helped somebody else out. So your transaction has given you money. You give the money to someone else who needs the money for another transaction. They give it back to you, and then you have the money available for when you need to do your transaction. That's the intermediation of the financial system, which requires banks to some degree. And banks have a nice way of finding the people who need it, or the people who need it finding the bank, and the people who have it to save. So banks are financial intermediaries that facilitate the flow of resources from surplus units to deficit units. And obviously the banks are trying to make a profit by doing this. This means that they have to give the saver X number of dollars in return, or X percent, let's say 5% return on their deposit, they on-lend the resources at 6% or 7% or 10%. And hopefully the borrower has enough creditworthiness that he will actually pay the money back, because if he doesn't, then the saver putting the money in the bank ends up with nothing. So we need the system to work. The banks will not lend to individuals who are not creditworthy. This creates no problem. The problem being that the individuals who are most creditworthy are the people who have the most money. And if you lend it to people who already have, the rich become richer and the poor become poorer. Assuming they have, but they just want to invest in other opportunities. So imagine 10 little people saving $1 and one big guy borrowing the $10. He has enough money now to make another investment. He pays it back. The little people get their return. The system is not working to make things better for everyone. Yes, you might say that the little people have gotten something, but they can't make the investment opportunities because the bank doesn't know them, doesn't trust them. So even if you have the money in the bank might still not be willing to make you a loan, because it's not just your savings that determine whether or not you are credit worthy. There's a whole list of other things, and obviously your project has to look as though it's a viable project. This brings us to another important dimension of financial intermediation in developing countries: the history of financial intermediation. So go back to a world of bartering, a very traditional world, and imagine the first banks that come to that economy. In the case of small economies that are colonies of major European powers, the banking system that's coming is the mother country's banking system. Usually a bank will follow the firms that it's servicing. That's the point of the bank, to service its main customers. So if the bank is going to, say, Jamaica, in order to service European companies that are doing operations in Jamaica, the main interest of the bank is not the local Jamaicans, it's the Europeans who are operating their businesses in Jamaica. It could be people who are importing, and therefore they are merchants selling stuff. So the person who is producing the product in Europe might have a representative in Jamaica, and this representative will sell the products. The monies need to be handled through a financial system. So the bank that comes will be the same bank that services this company in England, and therefore it's following its customers, so to speak. So the main aspect of banking was commercial transactions initially, hence called commercial banks. And if the resources are local resources, they come from the local people and their savings. But there are others who are operating in the local economy, so let's go for a large operation. So we'll go back to a major sugar producer, so to speak. The sugar producer needs to borrow money to plant and invest in growing his crop. He borrows money from the banking system. The banking system has this money from the importers who have brought stuff in and sold their products, so now they have this surplus of money. They could use it to purchase more inventory, but for a period of time, imagine that they have so much that the profits are such that they have enough surplus. So they put their money back in the bank, and the local farmer, hopefully a wealthy farmer, borrows this money and plants his crop and buys equipment, etc. So you see that the system can work to facilitate the behavior, the economic behavior of those who have, the merchants and the wealthy farmers. The small farmer can't borrow easily because he doesn't have the credit worthiness. His plot is too small. He is not producing on a large enough scale to ship his commodity to Europe, maybe. And therefore, he's outside of the financial system. What he needs to do is to produce an exportable product and somehow get into a system that will purchase his product, his production, and send it on to the mother country. So he is an appendage to the system, so to speak. As you think through that, then start with a world where the major players in the financial system are big firms, bigger firms in the local economy, and the small guys are, put them in the rural area. They have no interaction because they don't have the credit worthiness. Their financial intermediation is done through money lenders. I want to say loan sharks, individuals who somehow have a surplus and are willing to lend this money to one individual at a very exorbitant price or interest rate. Because it is not an organized system where there's a fixed or a common interest rate, you negotiate one-on-one and you hope that this thing can work for you. The main point is that the small guy is outside of the financial system and the big guy is inside the financial system. So in order to make financial intermediation better, you want to have the small guy gain access to this financial system, improve his credit worthiness, just get money into his hand. That is the thrust of what we need to focus on as we think about financialization, increasing financialization of a developing country, making monies more available to small farmers or small entrepreneurs, whereas traditionally it might have been the purview of the larger corporations because of the commercial nature of things. You can't blame the banks as commercial banks for seeking to finance commerce. You don't want them to finance investment when they don't have the resources to judge the productivity of your project. So you need a different kind of bank if you're going to start financing development projects. This leads us then into the realm of what are called development banks. We would call them merchant banks or venture capitalists or something like that in a more advanced system. But development banks then try to finance development projects that need resources that the commercial bank would not try to make available because the commercial bank has enough customers, thank you very much, and is not interested in financing long-term investments on risky projects. Short-term, stable projects, not projects, transactions, import, export, yesterday, today, tomorrow. That's the horizon for the commercial bank, and the investment bank has a longer horizon. So these are the institutions of financial intermediation we want to focus on. And then after we're done with that, we want to then focus on the aggregate macroeconomic monetary policy, which is the purview of the central bank. One institution, and the role of this institution in creating what is called monetary policy or effecting monetary policy. Bottom line is that the model we started discussing says that expanding the money supply in a developing country with a fixed exchange rate will generally not be very effective. If you are an open economy, which means that trade is very important, smart individuals will see that the central bank is increasing the money supply. That should, in theory, push the interest rates down, but what generally happens is that when there is more money, more local currency available, individuals who want access to foreign currency will then take the money they have and try to borrow foreign currency so they can buy more imports. And then we need more controls to prevent individuals from taking this extra money that's available and trying to purchase foreign currency. But if the foreign currency is priced at a fixed exchange rate and the central bank is willing to supply any foreign currency that individuals want at that fixed exchange rate, how do you prevent them? So now we have a system like the commercial banks. The commercial banks are saying to some individuals, you are not creditworthy, and therefore we will not even consider lending you any money. But now we have the central bank now having to determine, who do we give the foreign currency to? If everyone has the money to purchase the foreign currency at the fixed exchange rate, and there's therefore an excess demand for foreign currency, traditional economics says that when there's excess demand, the price should go up, which means the price of the foreign currency should increase. Fixed exchange rates, there's no increase in the price of foreign exchange. Therefore, we have excess demand, also known as a shortage. What happens when there's a shortage? The highest bidder should win. But if the price is fixed, then the first come, first served. And first come, first served doesn't necessarily mean you got there first, but first in terms of the seller's desire to sell. You are first in line, even if you come last, so he will sell it to you. And therefore, we have a system that doesn't work for the small guy again. What happens is that if the central bank is trying to defend a certain exchange rate, keep the price of foreign currency fixed, the individual who gains access to the foreign currency, he now walks out with all those, let's say, US dollars, and he's thinking, There are many people who want these US dollars that I just bought for this particular price, and they're willing to pay a higher price. Again, excess demand, the price goes up. And we create an illegal market, sometimes called a black market or parallel market. So the central bank has sold the foreign currency to someone that thinks is worthy of the foreign currency at a fixed price. This individual then goes and engages in rent-seeking behavior, selling the foreign currency to those who couldn't get access to it at that fixed price. He's made a profit. The central bank has egg on their face. And the question is, have we done anything productive in this way? So the central bank becomes a judge of who should get access to the foreign currency and how long they should have it for and the terms, and you can't resell the foreign currency. You must show us what you're going to do with the foreign currency. This is an older model I'm presenting, but because we are taking a historical approach, I'd like for you to understand this idea. The central bank then tells the individual who purchases the foreign currency, you need to tell us what you're purchasing the foreign currency for, a purpose, and we need to see the thing you purchase to verify that, or giving you the money at a low price, effectively subsidizing your imports, has been something that's in the economy's best interest. I need for you to get that idea. The fixed exchange rate, if the exchange rate is priced too low, the price of foreign currency is below market clearing, which means there's an excess demand for foreign currency. The price of the foreign currency should be higher, means that the individual who gets it has just gotten the subsidy. He takes the subsidy, purchases a product that increases his profitability, but he needs to show the product he's purchased. That product better be for the country's development. If not, you've just subsidized somebody who got there first. And this individual has no interest in helping the economy, helping themselves. Monetary policy can be ineffective. So that's the main thought pattern as we start this chapter. The role of the central bank is key when they ask the question, monetary policy, useful or useless. There are many dimensions to this, so I would recommend that you look at the Mundell-Fleming model. Let me get back to the other conclusions of the Mundell-Fleming model, and then I'll let you have at it. So the summary of the Mundell-Fleming model says that expansionary monetary policy in a world of fixed exchange rates will not be effective. Expansionary monetary policy will cause an expansion in the money supply, but this money will then go abroad, and therefore the money supply will be back to its original level. Individuals don't want to hold this money. The central bank has foisted it on them, but they can always take the money, transform it into foreign currency, and move the monies abroad. Interesting question. If you get access to foreign currency, do you purchase an imported good, or do you invest this foreign currency abroad? Obviously, if the central bank has acted to increase the money supply, and individuals then use it to purchase foreign currency to hide the foreign currency abroad, or to move resources abroad, these resources that the local economy needs are now outside of the reach of the local economy. So this is a strike against monetary policy if it results in individuals not wanting to hold the extra money and deciding to use it to move their monies abroad or to purchase imports that are not necessarily things that the economy can benefit from, luxury items rather than productive items. Expansionary fiscal policy then is the only arm that the policymakers have. And if you view expansionary fiscal policy as the purview of the government and expansionary monetary policy as the purview of the central bank, you view government and central bank as two policymaking agencies, then expansionary fiscal policy is the only arm that is effective. And you ask the question, how effective is expansionary fiscal policy? Well, we usually consider that to be real economic activity as opposed to financial economic activity. So if the government decides to expand its fiscal deficit to hire people who are unemployed, these individuals have jobs, they have money, they spend, this can help the economy to recover. I'm not going to use the word grow, because behind this equation is that if the government is borrowing the money to finance a fiscal deficit, then is the government crowding out private sector activity by bidding up the interest rates in order to get first dibs on this money that's available. So then it raises other interesting questions. Where is government getting the money to engage in expansionary fiscal policy. There are three ways to get this money. One is from the central bank, forcing the central bank to just engage in expansionary monetary policy to fund the government. Then the central bank in this case is no longer autonomous. It is basically serving at the behest of the government, and the government has a line of credit. And if the government decides it wants to spend more, it goes to the central bank and says, we need more money, print this extra money. Then the central bank has effectively created an inflation for the economy. So you have what looks like monetary policy, or should I say what looks like fiscal policy, but it's really expansionary monetary policy. Expansionary monetary and fiscal policy can occur together, and that's an important question to answer. Which comes first, the chicken or the egg, and what's the result? And they both work together. Expansionary fiscal policy, in theory, according to Mundell-Fleming, will bid the interest rates up, do some crowding out of the private sector, but hopefully it will cause the economy to grow if it doesn't crowd the private sector out too much. If it does not crowd the private sector out, expansionary fiscal policy can help to grow the economy. So set aside the local resources and say the government borrows the money internationally. For one thing, that's foreign exchange or foreign currency coming into the economy. More foreign currency available to do more things, imports, etc. So we have what looks like a good thing. Is that expansionary fiscal policy, or is that international borrowing? Well, let's call it expansionary fiscal policy because the government is going to use the money itself to do more productive activities, if government can do productive activities, goods and services, build roads, hospitals, etc., engage in development projects. Then it's really development spending. If government is borrowing to pay civil servants higher salaries, then this is not productive activity. So it has to be investment oriented for it to be worthwhile. Expansionary fiscal policy. So expansionary fiscal policy can cause the economy to grow, or maybe not if it is borrowing for the wrong thing. Expansionary monetary policy can lead to an outflow of foreign currencies, and we're not sure. It could cause the economy to grow if this expansionary monetary policy gets in the hands of people who are needing this extra money, and the lower interest rates will help them to engage in more productive activity. So that's the summary. Expansionary fiscal policy is better than expansionary monetary policy under fixed exchange rates. On the flip side, we move to flexible exchange rates, and somehow, interestingly, the results are reversed. Expansionary monetary policy is effective, theoretically, under flexible exchange rates, and expansionary fiscal policy is not. Without getting into a whole long conversation about why this turns around, I would say that the more important case for us is the fixed exchange rate regime, because in the flexible exchange rate world, what usually happens is that you should have an autonomous central bank. If the central bank is not autonomous, then effectively monetary policy is fiscal policy. And raising questions. Does expansionary fiscal policy, when it forces the monetary authorities to come along, so to speak, to finance the government deficit, how good would that be in terms of growing the economy? Interesting question. We can look at Latin America and see the cases, the Argentine case, or several Argentinian cases, where the government just went to the central bank and said, we need money, and the central bank provided the extra money, and it caused what were called hyperinflations. This is a story throughout much of Latin America, hyperinflations. The central bank, at the behest of the government, making monies available, the government doing the wrong thing with the money, so to speak, and therefore we have ineffective monetary/fiscal policy. That's our starting point. Okay, take it from there.